Welcome to the training for a session for tax preparation strategies for childcare businesses. My name is Cheryl Orr, and I am the Early Learning and Care Representative for Central and Northern New York. It is with our membership that we are able to negotiate the funds for these great free to you training sessions. These trainings benefit you and your business, and with a strong membership, we can continue to negotiate these great benefits. We encourage you to become a member and invest in yourself and in your business. You can sign up on our website, email, or call our resource center if you have any questions. Thank you so much for attending tonight, and I appreciate your time. I'm going to turn it back over to Lee so she can give you some housekeeping details.
Thank you. And we are from the Work Institute. We are also part of CSEA, and we are just delighted to have you here. At the end, I will be also including some links for a survey so that you can tell us all about your experience and your thoughts on tonight.
I would like to introduce our trainer this evening, Marlene Toby.
All right, thank you so much, Cheryl and Lee. Hello, everyone. Pleasure being with you this evening. We are going to be talking about your tax preparation strategies for childcare business. So in this presentation, we will share a process that's using a limited amount of information so that you can gauge your taxes and go through options that you do have to mitigate your tax bill before the end of the year. So before we jump into the presentation, I'd like to first provide a disclaimer. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited, and only non-commercial uses of this work are permitted. All right. Now that we have that out the way, welcome everyone. In today's session, we will be covering some very important tax topics that will help you to run your childcare business smoothly year-round, not just during tax season, as I mentioned before. So first, we will discuss why you should care about your taxes throughout the year and not just on April 15th. Next, we'll explain what the Schedule C is and how to use it so that you can report your childcare business income and expenses. We'll also go over the steps that you should take now so that you can get organized and prepare for tax filing season next year. And then finally, we'll share tips to proactively mitigate your tax burden through deductions, contributions, retirement plans, and more. So our goal today is really to provide you with some tax knowledge that will help you to optimize filing and minimize those headaches when tax season rolls around once again. Okay. All right. So let's start with why you should care about your taxes. Knowing how to effectively address taxes can help you with a number of things. First, it helps with profit retention. Now, while it is the responsibility of every business to pay their fair share of taxes, proper tax preparation can be a vehicle for recapturing all that hard-earned profit that you've made and keep that money in your pocket. So understanding your allowable expenses basically results in legitimately paying less taxes and retaining those profits. The second reason is risk mitigation. Now, education is key when it comes to understanding your allowable expenses and properly preparing your taxes. So the more that you are aware of the tax rules as they apply to childcare businesses, the less likely you are to trigger a costly IRS audit. Now, audits are very time consuming. They can cause a lot of distress. And at the end of the process, you may find it to be very costly and it most likely will result in you owing money that you may not be prepared to pay. The third reason is helping you to understand your business health. So, reviewing your taxes is a fantastic way to evaluate the health of your business. Having an accurate account of profit really allows you to understand the financial position your business is in, and it can help you plan for any changes going into the future. And our fourth reason is it can help you build business confidence. Excuse me. Now, having confidence in knowing that you have properly claimed deductions and have met your tax obligations removes the factor of the unknown. So, understanding taxes gives you the ability to continue to operate with the mindset that you are following the rules that are set by the IRS, and you're unlikely to have any unforeseen debt or potential problems in the future. Excuse me. Sorry about that. I had a tickle in my throat. Had to take a little drink. All right. So, I want to talk a little bit about our research that we have done. And just a quick reminder that if you do have your mics on, please make sure that they're on mute so that there's no feedback and everyone can hear. And I appreciate you for that. And thank you. So our research on past taxes illuminates several findings. We've basically found a few things as we work with childcare business owners every day. And the first is that 83% of childcare providers have not claimed or did not claim their business use of home at all. Now, the IRS does allow for these deductions on the Schedule C, line 30 for business use of home. And you can take deductions that are associated with those costs, but we found that 83% of providers did not claim those expenses. Now, in some cases, providers did not claim any expenses at all on their tax returns. And this should never happen, as every dollar is important to reinvest back in your childcare program. And undoubtedly, you as a provider have deductible expenses. You had those that were required to open. So there should never, ever be an instance where a provider is unable to find or claim expenses that are associated with your childcare operations. Now, the IRS Schedule C has many expense categories under which deductions can fall. So we do encourage you to review each category to identify those qualifying expenses so that you can lower your tax liability. Also, many providers were claiming invalid business expenses, which drastically increased their chances for an expensive and time-consuming IRS audit. Now, while we do advocate for valid expenses, the key word there is valid. Not all of your expenses will be valid for your childcare business. Some expenses automatically will even trigger audits or raise red flags. So, as a rule of thumb, the IRS considers a valid deduction to be what they call ordinary and necessary, which basically means it's required for your operations of your business. Now, the IRS evaluates if expenses are appropriate based on your business type and by reviewing your tax returns. Another key finding was that several common deductions were often miscategorized or improperly calculated. Now, when this happens, it can also raise those automatic red audit flags, even if the deduction was valid. Now, an example of one of those deductions that would be the children's meals. Now, we found that many childcare providers were deducting children's meals under the line on Schedule C for deducting business meals. Now, the IRS intends to use that particular line for providing business meals when you're traveling, but it's not for the children's meals. So, high expenses in the wrong category can definitely prompt an audit, even if it is unintentional. So, we want you to be very careful and cautious of where you're placing things. And we'll talk about where some of those categories belong. But keep in mind that there are a number of different tax forms. Income for sole proprietorship, that's reported on the Schedule C as part of your personal 1040 tax returns. Now, if you have more than one business and they are not closely related, you will need to file more than one Schedule C. Now, I'll give you an example. Let's say that you have a craft business, and maybe you drive for a rideshare service like Uber or Lyft. If that is the case, those businesses are not closely related, and therefore you will need to fill out two separate Schedule C forms for those businesses. Now, when you are completing your Schedule C, you first are going to report your revenue, and that's all the money that you receive for your business. You then will be able to show your expenses, and these are the things, of course, that you paid for to keep your business running. Excuse me. Then you calculate the amount that remains. And if it's positive, you have made a profit. If it's negative, then you may be operating at a loss. Right. So I want to take a closer look at the Schedule C so you can view the different sections for reporting data on your business. Now, if you use tax software, uh, it will basically enter these numbers in for you based on the answers to various questions that you will answer, but it can still be very helpful for you to know your way around this very important document. So we're going to break it up in parts. Part one in the pink, this is where your sales are totaled and your cost of goods sold is reported, excuse me, so that you can see your gross profit. I want to make a note that typically cost of goods sold is something that childcare providers will not be reporting. Now in part two, in the green, this is where your business expenses are reported. There are over a dozen categories listed to help you stay organized, such as advertising, car and truck expenses, legal and professional services, rent, travel, meals, and a host of other costs. And we do have a resource that will help you to look at some of those categories, which I'll share in a little bit. The last section in the gray is where your net profit is calculated, excuse me, on line 31 by subtracting your total expenses in part two from your total revenue in part one. But your net profit is considered your income from self-employment. Right, so now let's switch gears and discuss how you can proactively prepare for tax season and avoid those headaches down the road, as I mentioned before, because you know proper preparation is key to helping you tackle tax time like a pro. So here is that valuable resource that I made reference to a little bit earlier. This is going to highlight tax preparation, and it is preparing for tax season. This is a guide from Playground. This work from Playground aims to help our home-based childcare providers be able to optimize their tax preparation process and, of course, maximize all of the deductions possible. It does cover a host of topics, as I mentioned before, like record keeping best practices that you can implement now, such as tackling your income and expenses and mileage and your business use of home, understanding the Schedule C and where to capture your income and different types of business expenses. It talks about how the business use of home deduction actually works, including calculating and documenting your time space percentage, which we will cover a little bit later. Maximizing write-offs with eligible deductions for supplies, meals, utilities, repairs, insurance, and more. It also talks about tracking and claiming your automobile mileage for the business travel, depreciating assets like equipment and furnishings over time, and choosing the right business structure, such as an LLC versus a sole proprietorship, and so on and so forth. And of course, the proactive tax planning steps are included that you can take this year so that you can maximize your returns in the following year. Now, this workbook does include checklists, guides, and visual examples that basically walk you through every step to support you in preparing for tax season and providing those actionable steps that you can implement now to make your tax time a little bit easier, and it will help you to save money. Okay, so when it comes to understanding your taxes, you will find that it's all about what you made and what you spent. So the first section of your taxes is all about revenue, and that is how much money you made. Now, getting this information may be very easy if you have an accounting system, but if you do not, no worries. You can also use your revenue worksheet. We are going to show you an example of that here, and you can use that to calculate it. The first thing you're going to do is start by gathering all of your records. Now, you are likely to have 3 types of records for revenue. Excuse me for a second. All right, so the first form of revenue would be a 1099. Now, these are evidence that another business paid you for services. Many home-based childcare businesses will receive a 1099 for subsidy payments. If you're on the food program, you will also receive a 1099 if you receive more than $600 in payments from apps like Square, Zelle, or PayPal. Now, I will share some information with you guys towards the end in our Q&A in reference to some changes that have happened in reference to our apps in terms of how much money you can make. And there have been some changes throughout the years for 24, 25, and 26. So I will share that information with you all during our Q&A. The second form is our bank records. This is where you're showing additional funds that you may have received from other sources. And then, of course, the third is going to be your own documents, such as your year-end or weekly receipts that show that the parents paid for care. The next step is to fill out the revenue worksheet. Now, this sample is from the tax guide that we'll also share a link with you in the chat. Now, in this section, you want to include each of your 1099s and revenue for every child that you have served. You also want to list income such as grants that may not already be accounted for on a 1099. Now, keep in mind, you may get a grant, you may get a 1099 for grants that you've received. So you do want to make sure that you're not double documenting this information. So if you don't receive your 1099, just enter that information in there. If you do, only enter it once using that 1099. Now, if you receive reimbursement for food costs through the food program, you can report all the reimbursement under the income section of Part 1 of the Schedule C using your 1099s that you received. You can then deduct your food expenses in full in the expense section. There are some caveats to that. There are some programs that may not be able to deduct 100% based on their time, space, and location of certain things in their home that they use for their business. Okay, 1 second. The tickles really get to me today. All right. So now that you have your business income, you will then need to collect your expenses. Now, this will be what you spent money on for your business in the previous year. And you want to make sure that you have records of all your costs, ideally receipts showing payment for expenses, but you can also, in most cases, use canceled checks or invoices or even credit card and bank records. Now, it is critical that any proof of expenses show first that you paid the expense, the amount you paid, the date you paid it, and a description of the item purchased or the services rendered. Now, we do have a mileage log, which is included as a resource in the guide, and we will share that via the link. And this is basically a simple log that you can use to fill in your vehicle use information. Excuse me. Now, to collect your expenses, you will want to start by collecting all of your receipts. You're going to go month by month in your records for the previous year. Review your credit card bills, check any of those app-based payment systems like Venmo, Zelle, PayPal, or Square Cash. And of course, look at your bank statements and those checks. Now, with your accumulated expenses, you can now then fill out the digital worksheet, which is included in the guide. And of course, we will link that for you. The worksheet uses the expense categories for the Schedule C that are most relevant to home-based childcare businesses, but they can also be used for any corporate or partnership tax returns as well. Now, the full amount of home expenses that are directly related to your business can be then included in your expenses in the table. Now, the IRS does define a direct expense as one that is incurred exclusively for the business and provides no personal benefit. So some examples of a direct expense in your home would be fixing a bathroom used only for the children, or getting a new children's rug for your play area, and even playground equipment. Excuse me. Now, indirect costs associated with your home, such as maybe your homeowner's insurance or electric cost, those will be covered in the following section, which will cover your business use of home. Now, you should keep all your pay stubs during tax season and keep those for at least 4 years thereafter. And it's also great to have both paper and electronic copies, even if you get the second copy just by using your phone to take a digital picture. Excuse me. Now I want to cover a couple of topics that we often find to be tricky for a lot of individuals, and that will be vehicles, food, home, and grant funding. I want to start with your vehicle. Now, as with all deductions, there are some very specific rules and guidelines that you will want to follow. So here are all the elements that you'll need to make sure that your transportation is deductible. Now, it must be, of course, in the regular course of you doing business, and it has to be related directly to your childcare business, like if you're doing transportation for the children. And it has to be business related, like if you're going to the grocery store to pick up milk for the children or food. Excuse me. Now, you always need to keep your personal and your business travel separate. Excuse me. Now, when it comes to business trips, the primary rule is that the trip can be for both personal and business purposes, but it's only deductible if the primary purpose of the trip was for business. One more second. Now, I want to give you a couple of examples. If you go to Costco, maybe to purchase a long list of supplies for your childcare center, and you happen to pick up a personal item like a jar of pickles, then the trip would still be deductible since supplying your business was the main reason for going. However, if you went to the grocery store for your own groceries and you just so happen to pick up an item or two that you need for your center, that trip would not be deductible since your personal errands were the primary driver. Now, the key is looking at why the trip was necessary in the first place. If the main purpose was for business, it can be a deductible trip, even if you happen to pick up some personal items along the way. But if the excuse me, if the priority was personal, with just maybe an incidental business purchase here or there, then it's not going to qualify as a valid business expense. Now, if you happen to use your vehicle to conduct business for your childcare, then you might be wondering how you could deduct those transportation costs. And there are two ways to deduct your vehicle expenses. That is the standard mileage rate and the actual expense method. And I'll cover both of those here in bit. Can I get rid of this tickle? Hoping that tickle's gone away now. So let's start with the actual expense method. This is going to capture all of the costs associated with your vehicle, but it does require some extensive documentation, including keeping all of your receipts and logging mileage for both personal and business use. Now, there are pros and cons to both of these methods. We'll start with the pros. The pros of this particular method are that it may result in a higher deduction, especially if your vehicle is used extensively for work. However, the cons are that it may take a significant amount of time to collect and even retain all of your receipts and mileage logs. So with the actual expense method, although it can provide you a larger write-off, it also demands careful record keeping so that you can track both your business and personal use, as well as proof of payment for all of your vehicle costs. Now, alternatively, the actual the mileage method. This is basically going to simplify those deductions by tracking your expenses. You won't have to do as much. You can use what the IRS calls the standard mileage rate, but you're still going to have to do some detailed logging of your business miles that you've driven. This has pros and cons as well. The pros of the standard mileage are that there's an ease in calculation. You have fewer records to collect, and you only need to track your business miles, not necessarily your personal miles. However, the cons are that the deduction is limited to the fixed rate, which is set by the IRS, and your records may be subject to greater scrutiny by using this method. Now, regardless whether you use the actual expense or standard mileage rate, you still need to log everything down. So there, you need to make sure that you're keeping track of with a log, and the log has to note the date, the distance that you've traveled, the location and purpose of each of your trip, and you should specify whether it is business or personal. Now, while standard mileage reduces the documentation burden, you still have to carefully track your mileage in a log, along with the trips and the details to justify that particular deduction. Now, we do encourage you to compare the effort that is needed for each of these methods when you're deciding which one is going to work best for you, your business, and your campus. Now, the basic deductions for food, moving on to the food, basic deductions for food and meals are that food is fully deductible with two exceptions. The big question is, how do you do it? Well, children in your care are fully deductible, and you can report the cost in multiple ways. For staff, only 50% is deductible, and for your own children, those costs are not deductible. Now, there are two methods that you can use to deduct your food cost, and those are the actual expenses and the standard meal rate. Now, you can deduct as a business expense 100% of the actual cost of food consumed by your daycare children, and generally only 50% of the cost of food that is consumed by your employees. However, you can deduct 100% of the cost consumed by your employees if the value can be excluded from their wages as what is called a de minimis fringe benefit. Now, these are basically benefits that you can give your employees that are lower in value and excludable from their taxable income. Now, if you happen to have a child care center, you can only use this method of expensing food, and you can't use the standard rate. But if you do participate in the food program, you will already be experienced in how to document the children and the types of meals. So you'll only need to factor in the actual food cost. All right, so to simplify record keeping requirements, there is an optional standard meal and snack rate that family daycare providers can use when computing their deductions, the cost of food, which is provided to the children in care. This is done by keeping track of the meal types, the numbers, and then multiplying by the set amount that is established by the IRS. Now, there are pros and cons, of course, to this one. The pros here are you have easier record keeping. You can still deduct those non-reimbursed meals and snacks, and that is a big pro, and I'll give you some more information on that in a second. The con is that you still need to keep the name of each eligible child, the date, the hours of attendance, and the number and types of meals served. Now, the food program reimbursement rates, they can be used by home-based childcare providers to basically simplify the calculation of food costs, regardless if you participate in the food program or not. Now, this rate, it is based on Tier 1 rates under CACFP, and you can use the standard meal rate to claim a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day. Yes, I said that correctly. And I'm going to repeat that because sometimes I get questions on that. You can use this to claim 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day based on what you have served. And this does vary from what the food program reimbursement allowances are, which are typically 2 meals and a snack or 2 snacks and a meal. Now, we do have a link for you to be able to view the reimbursement rates, which I believe has been dropped in the chat or will be, and we'll link those for you. And if it's not there now, it will be in the end. All right. Now we're going to move on to your home. So to figure out how much of your expenses are considered business expenses and what percentage of those expenses can be deducted on your income taxes, family child care providers will use what we've referenced already, the time space calculation. Now in time space, you're going to classify your space as either regular use or exclusive use. Now we will look at the definitions for both of these. Regular use, those are the areas that you're going to use all day. That could be your play area. And it can also be areas that you use part of the day, like your napping area. Excuse me, napping areas. But these areas may have other uses during non-business hours. Like let's say maybe it's your living room and you're using it for your family. Now, exclusive use, on the other hand, those are the areas that are only used for your child care program and nothing else. Okay. Very important to remember that. So we're going to look at a few examples. Exclusive use would be having a separate basement entrance that is only used by the families of your child care business, or maybe even a storage room that only contains toys or supplies for your business. Now, on the other hand, regular use would be using your bedroom daily for nap time for the children, or maybe even your living room for STEM activities, but you still have that shared use for your family. So exclusive use spaces can fully be deductible based on the percentage of your total square footage. Of course, since it is 100% for the business, that's why you can deduct it fully. Regular use, on the other hand, is deductible based on the percentage of time that is used for business rather than personal. So properly documenting both types of usage is going to be key in justifying your home office deduction. All right, so home costs can be fully or partially deductible depending on the nature of the expense. Now, cost for exclusive use areas are, or direct business costs are likely to be fully deductible, like replacing the towel on your basement floor that's only used for the child care, installing maybe a child-sized toilet, or even having liability insurance. Now, these would be fully deductible since you only need these for your business, or only the children will be using a child-sized toilet, hopefully. Now, expenses for regular use spaces or common improvement areas are only partially deductible based on your business use percentage. Now, examples of this would be replacing all the windows in your home, repaving your driveway, or having home insurance, since those will impact the entire property, not just your business. Now, in regularly used areas, you need to use the time space calculation to determine how much can be deducted. So we have already referenced the time space calculation, and I do want to walk you through that calculation in just a moment. But the key is to identify whether a cost directly supports the business or if it benefits shared spaces or is a general home improvement. And that's how you're going to determine if it's fully, partially, or not deductible. All right. Keep in mind that if you do have questions, go ahead and make sure you're dropping them in the Q&A or the chat, and we will get to those during the designated time. Now, remember that in time space, you're going to classify your space as either regular excuse or exclusive, as we talked about. Now, the time portion means how much time those regular areas are used for your business. And exclusively used spaces are, again, weighted at that 100% because there are no other uses for those spaces. Whereas our regular use spaces are weighed at the portion of time that your home is used for business purposes. Now, you can determine your time space calculation using 6 easy steps, which we do have here. The first is to determine the square footage of your regular use space. The second step is to divide this number by your home's total square footage. Third is to determine the amount of time that your home is used for childcare. The fourth step is to divide the hours by the total hours in a year, which is 8,760. Fifth step would be to multiply the time and the space percentages that you will calculate. And the sixth step is to divide the exclusive use space by the total square footage of your home and add it to the results that you gained in step 5. Now, using these steps, we can easily help you determine how much of your expenses or how many of your expenses can be reimbursed or deducted from your federal income tax. We are also including a link to a free worksheet that you can use to calculate your time space percentages on your own. So here's an example, because I really want you guys to capture the essence of time space. So we're going to attempt to calculate this together. Now we're going to go through those steps that we mentioned on the previous slide. And I want you to work alongside me to see if you can determine this provider's time space percentage. Let's take a moment to look over the information that's provided in this example. First, we have a business that has a home with 1,500 square feet. 500 of those are exclusive use space, and 700 are your regular use space. So we've given you a lot of information here, but we're going to walk you through the process of how you calculate all of this too. Now, this particular provider is open 10 hours a day and spends an hour before and an hour after for prep and cleanup. And then she is closed 2 weeks out of the year for vacation. Okay, so keeping all of that in mind, we're going to go ahead and take a look at this provider's example, and I'll walk you through step by step. So step 1 was to determine the square footage of the regular use space. Now, in this case, we already know that the home has 1,500 square feet, and 700 of those square feet were used regularly. But if you need to know how to calculate your square footage, you're simply going to take the length of the room and multiply it by the width of the room, and that will give you your square footage. Now, if you happen to have some oddly shaped spaces in your room, like a closet or a nook, you can still calculate the square footage using the same method. You're just going to break your room into smaller rectangular blocks and then use the same calculation that we just talked about, length times width equals square footage. And once you get the calculations for each of those blocks, you're simply going to add them together. Now, step 2 was to divide the square footage of the regularly used childcare space by the square footage of the home to determine the percentage. So we know already that 700 was regular use, and we also know that 1,500 was the total square footage. So if we divide the 700 by 1,500, it gives us a decimal, which we then can convert to 46.7%. I just rounded that up. Now, oftentimes, you do not have to round for time space percentage, but for this particular example, we are rounding. Okay. Now, please note that square footage for outdoor areas cannot be included in your time space calculation. There are some exceptions though. External spaces that are physically attached, I'm going to say that again, the external space must be physically attached to your home and regularly used by the children, and those can be included. Now, an example of that would be like a deck that you're using or an enclosed porch. Okay. Then we're going to move on to step 3, which is to determine the amount of time that your home was used for childcare during the year. To do this, we're going to calculate how many hours the childcare space is open per week, including that time that was spent preparing and cleaning up when the children are not present. Then we're simply going to multiply this number by the number of weeks open for services and add any of those hours that were worked that the provider performed while they were closed. Now we have some givens here. We know that she was open 10 hours per day. And we also know that she did an hour of prep and an hour of cleanup. So if you add all of that together, we're going to come up with 12 total hours used. We're going to take that 12 hours per day that was used, and we're going to multiply it by 5 days a week, because most of us work 5 days. If it's 6, then you can multiply it by that. And then we're going to multiply it by the number of weeks she was open, which we know were 50. So once you get all of that, it gives you 3,000 hours. With me? All right, moving on to step 4. We're going to divide the hours that the home was used for care by that number we were given in the very beginning, the total hours in the year, which is 8,760. So we take our 3,000 hours used for care, divide it by 8,760. It gives us a decimal point, which we can then convert to 34.2%. We move on to step 5, which is to multiply the time space percentages. Now we just did 2. So we do this by taking the square footage percentage, which we just calculated at 46.7%, and the hours per year percentage, which was 34.2. And we simply multiply them together by converting them back to decimals. We're going to get another decimal. It will give you 15.97%. If you want to round it up, it will be 16%. In step 6, we are then going to divide the exclusive use spaces by the total square footage of the home and then add it to the results that we just received in step 5. So we know that here 500 square feet were used exclusively for the childcare. And of course, there's 1,500 square feet total for her home. So we're going to take our 500 divided by 1,500, and it's going to give us a decimal point, which we will then add to our 16% that we got in step 5. And that will give us a decimal, which we can convert to 49.3. Now, it could be 49.2, depending on whether or not you're rounding. But this provider's allowable time space percentage deduction would be based on this example, 49.3 of allowable home expenses. All right, hope that made sense to everybody. Please note that if you have questions about it, do not hesitate to drop it in the Q&A or the chat, and we'll get to those at the designated time. And now we're going to move on to grant funding. Now, the general rule is that any stimulus funding or grant money that you've received must be reported as income. However, you can deduct any valid business expense associated with these funds in the same tax year. Now, timing of when the income was received versus when the expenses are incurred can impact your tax situation. So let's take a look at 3 different scenarios. All right, so here is the basic one, the first one that you're looking at. Very straightforward. the business receives $10,000 in grant money, which they report as revenue, and then they spent that same $10,000 in expenses in the very same year. So in this case, nothing changes on their taxes. So they received 10, they spent 10, so there's zero taxable income there. Now, let's say that the business received the same $10,000, but only had $5,000 in expenses in that year. So in this case, you're going to have to spend or pay taxes on that $5,000 difference. So if you receive 10, you only spend 5, that would leave $5,000 in taxable income. Now, in the next example, let's assume that a business received $10,000, but with like some grants, they were able to attribute that spending that happened in a previous year. In this case, this person would have to pay taxes on all 10,000 because there is nothing in this particular year. They received the 10, but it was attributed to a different year. So in the year of 2024, let's say that that's what you're doing, you're filing and you spent the money in 2023, you would have to pay the taxes on all $10,000 in that year. Okay. Now, some people might wonder if there's a way to mitigate your taxes even after the tax season has ended, and there are some options. So we will talk about those here. Now, if you're still looking for ways to mitigate your taxes for this tax year, you still have an option, and that is to contribute to a retirement plan. If you don't already have a retirement plan for your business, then setting one up could provide you with tax advantages. Now, contributions are made to a retirement plan on behalf of the business owner and employees, and they are typically tax deductible. So as a small business owner, you can open what's called a SEP IRA for both you and your employees from January through April 15th. You can make contributions to that SEP and it will reduce your previous year's taxes. You will also want to discuss these options with a financial institution or advisor to get more information on setting up these retirement accounts. Okay. Now, while you may not have options other than investing in a retirement plan to mitigate your taxes after December 31st, if you find yourself with higher taxable profits than you expected, then it is the perfect time for you to use that money wisely. So we recommend considering the following actions to make the best use of that money. The first is to pay down your debt. Now, if your business has any debt, this could be a great opportunity for you to pay some things down. This could also save you money in the long run because it will help to reduce the interest payments. And we all know that over time, interest accrues and you pay more and more money. So paying that down early could help to reduce that. A second strategy would be to create a reserve fund. Now, having a financial cushion can be very beneficial for your business. And if you have higher profits and steady expenses, then you may want to consider setting aside some of those funds from your profit in a reserve fund to cover future expenses or even unexpected cost. The third option is to invest in business expansion. Now, when you have higher profits, you might consider investing in the growth of your business. This could involve maybe hiring more staff, expanding your physical premises, launching maybe new products or services if that's what you do, or investing in marketing and advertising. Now, these investments could potentially lead to even higher revenue in the future. And note that these will also be allowable deductions in the new tax year. And then our next recommendation is to set a time for doing what we call a mid-year tax review. Now, many business owners do tax check-in, usually between August and October. And despite the fact that this is actually late summer and early fall, you will often hear this referred to as a mid-year tax review. Now, this effort can be an important one since it allows you to see where your tax liability is heading before the close of the year and when many opportunities to affect your tax liability have already ended. Additionally, conducting a review can help you to understand your profit, your tax liability, since you are required by law to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes to avoid having to pay a penalty. Now, a tax review before the end of the year can help you plan how much more you need to pay in estimated taxes to avoid paying more in penalties. Now, this review does involve checking your revenue and your expenses and comparing them this year to the previous year. And you also are going to want to do that with your resulting profit. So you'll also want to check how much you have paid in taxes so far. Now, this process can be either as in depth as you choose or not, but from just seeing if you're making money or making a profit to basically preparing your own taxes. Now, let's pivot into talking about how you can get your taxes prepared. Now, here are some brief pros and cons. Uh, it's a list that we have comparing paid tax preparers to self-preparation, and hopefully this will help you to decide what method might work best for you in your business. So, for paid preparation, when you are searching for a tax preparer, you want to look for someone who has been recommended by people in your network. Additionally, it is beneficial if they have child care specific expertise, particularly with businesses like yours, if that is possible. What do I mean? Apples to apples. If you are a home-based childcare facility, you would like to find someone with that experience and knowledge preparing taxes for home-based childcare providers. If you're a center-based, hopefully you are looking for someone who has that knowledge in center-based. Now, it doesn't mean that they can't help you if they don't have that. It's just always best to have someone who has that knowledge and expertise in preparing your specific type of tax returns. All right. So there are pros and cons. The pros are that you're going to have a guide along the way, but the cons of this is that it can be more expensive uh, to do the paid preparer. Now, for self-preparation, this is often more cost-effective and efficient for most providers, and the IRS tends to audit online computer-generated tax returns less frequently, as they do find them to be more accurate and beneficial for taxpayers. Pros and cons here are the pros: calculations can be more accurate and it's less expensive. The cons are that if you want a guide, it may be an additional cost. Now, regardless if you decide to take everything to a professional tax preparer or utilize additional resources and tools to complete your taxes on your own, you should implement systems now to track your income and expenses and deductions so that you can maximize those returns. Now, when you're looking for a tax preparer for your business, you should also ask various questions. The first is, are they qualified? Now, all tax preparers should have an IRS preparer tax identification number. It's referred to as a PTIN. Paid tax preparers are required to register with the IRS, so please be sure to ask for this in advance, as they are not allowed to prepare your taxes without one of these. And you can use the IRS directory to verify a preparer's PTIN credentials. Also, you want to ask, do they have training or did they receive training? Ask if that preparer has any professional credentials. People like enrolled agents who are licensed by the IRS, certified public accountants, or attorneys, they all work as tax preparers. Other qualified preparers may be participants in what we call the annual filing tax season program. They can be bookkeepers or even certified financial planners. So you can search for qualified tax preparers in your area using the IRS directory of federal tax return preparers. Now, the next question would be, have they worked with childcare businesses before, or do they understand your needs? Very important that they have childcare experience, regardless if they've worked with your specific type of childcare or not. It's very important. Now, experience counts when you're looking for a qualified tax preparation service. So in addition to checking the length of time for their previous experience, you do want to make sure that your tax preparation service has that knowledge relevant to your specific circumstances. Ask if that tax preparer is part of a professional organization, if it takes continuing education classes so that they stay up to date. And please make sure that they know state and local tax requirements in addition to those federal return requirements. The next question is, are they available after tax season for advice and changes? And can you get a copy of your returns? You do want to make sure that you have a hard copy of your filed returns and all the documents, including your everything that you submitted in your filings. Now, aside from the fact that it's good to have a copy for your records, you never know when you might need a copy quickly. And while several of these online tax programs will allow you to log in at any point in time and download a copy of your returns, some tax preparers may not be as easily accessible outside of tax season. So you want to check for that. And in addition to having those hard copies, it is recommended to have electronic copies as well. Now, digital copies can, of course, be made by scanning those hard copies, converting them to PDF files, or the simplistic way of using your phone so that you can document things, and then, of course, filing them in a secure manner or on a secure device. And then finally, we ask that you make sure that all of the original documents that you submitted to your tax preparer are returned to you. And then keep all of your receipts, your proof of payments, any 1099s, and all other related documentation for at least 4 years. Now, if you want to complete your own taxes, there are some online guides available for you to use. And these guides are designed specifically for childcare providers who want to use online tax software. So we have guides available for TurboTax, H&R Block, and TaxAct, along with the buyer's guides that will help you to choose the software that best suits your needs. We have provided links for the TurboTax Self-Employment Online Tax Preparation Guide, and this is for childcare businesses. And we also have included a link with all the guides that can help you to understand grant funding, taxes, managing your business finances, and your business operations. Now, these tools are free, they're easy to use, and include screenshots so that it is easy for you to use. There is a QR code there. You can simply take a picture of that, and it will take you there, as well as we will provide the link for you in the chat. And one more great resource is the Confidence and Quality Tax Rubric app. This was developed based on actual family and center childcare provider tax returns to help providers and their tax preparers understand specific tax regulations for childcare. Now, the rubric is designed for sole proprietors and LLCs that are single members. That is, they basically report their income and expenses on a Schedule C form 1040. Now, providers with S corporations or C corporations, partnerships, or LLCs that declare themselves as S or C corporation, they can still benefit from using this app, but the expense lines will just look a little bit different. Now, this is free and easy to use as well. And we do encourage you to test out the rubric for yourself, see how it benefits your business. We will share that link with you, and keep in mind that this app is also available in English and in Spanish. And we also have a proactive tax planning tool that can be particularly helpful to your prior year-end taxes. And so we encourage you to take a look at all of those apps that we will be providing you. Now, as we draw to a close, want you to know that it's very important to reflect on the insights acquired about accurately reporting your revenue and deductions for tax purposes. So the next critical step will be for you to collect your financial data for the current year and facilitate a connection with the most suitable preparer available if you're opting to have someone prepare your taxes. Now, whether you decide to tackle your taxes by yourself or enlist the help of a qualified professional, it is important to take advantage of the confidence and quality tax rubric. This tool is instrumental in maximizing your deductions and minimizing your risk. We also strongly encourage you to utilize the tax prep guide, which was sponsored by Playground. And please note that the review of a tax situation using this information contained within this presentation will not be a suitable a substitution for carefully selecting a qualified tax preparer and should not be used in place of legal or accounting advice when needed. All right, now we are at our Q&A, so I am going to open up the floor for questions. Let's see if we have any in the chat. And Tim, if you could check the Q&A for me.
Yeah, we have a couple in the Q&A here.
Okay.
Are you able to see them, or do we read them off for you?
Would you please read those?
Yeah, absolutely. Our first one is, hello, I would like to know if there is a list of expenses, or can I find this only in Schedule C?
So that's a great question. Who am I addressing with this question?
Zenaida Rodriguez?
Okay, so Ms. Rodriguez, if you go to the Playground link that we referenced, it has a complete list of all of the expenses that you can and should use if you are looking to claim some deductions in your taxes. So I do recommend you're going to have to register for it first when you get that link. But once you get registered for it, please go in there, take a look at all of that. It has so much information and it will definitely show you all of the various categories that you could utilize to help with preparing your taxes. Thank you for your question. Do we have another one?
Yes. Next one comes from Laura, and she says, could you give me an example of exclusive use?
Okay. So we did have a couple of examples, but let's say you have a bathroom that's only used by the children and it has a child-sized toilet in there. That's going to be an exclusive use area. A closet that you only store childcare toys or supplies in, and you don't use it for anything personal, that would be considered exclusive use as well. Okay, great question. Thank you. Tim, I'm going to have you go ahead and read all of those questions, and then I'll go ahead and get to the chat.
Okay, we have a couple more here, and just to clarify, the Playground link is what I recently just sent in the chat, where it says preparing for tax year. That is the Playground link we are referring to. So obviously had the word playground in it. That is the document that we are referring to.
Perfect. Thank you for the clarification.
The next question we have is also from Laura. It says, could you review how much we need to have put aside for taxes? Did you say 50%?
So that's really going to depend on how much you have to pay. So we do recommend you doing the quarterly. So if your accountant or tax preparer is helping you to prepare your taxes and pay those quarterly, it will help to minimize the amount that you have to pay. So everyone's going to have to pay a different amount based on certain factors. So really that's something that you would collaborate with your accountant accountant on and make sure that you understand how much you're going to need to pay quarterly. But also be cognizant of the fact that if you happen to pay more than necessary, sometimes adjustments are made, like you may certain things change in our businesses over time. So, there's always the little ebbs and flows, the ups and downs, our roller coaster. We want to make sure that you are adjusting for those. So let's say you did a $600 payment, and at the end of the year, you owed $900. Um, that extra $600 payment, if you keep making those, you'll find that in one of the quarters, you may not have to pay the full 600. You can only just pay the remainder, which would be 300. So it just depends on a lot of different factors. So our recommendation is to always consult with your personal tax consultant and or your tax preparer, and to make sure that they have you set up on a quarterly basis to make sure that you know what those taxes, estimated quarterly taxes will be, and pay those on a consistent basis. And quarterly taxes are going to be every 3 months. So they usually fall, I believe, January, and then 3 months, each 3 months after that. So, and they usually fall on the 15th.
Our next question comes from Yanirsi. They ask, how long do I need to keep records for IRS tax audit? I have heard that you need to keep records for at least 3 years. Is that true?
So our recommendation is 4 or more. Sometimes I've even heard 7. I would say what we have recommended was 4 years, but if you want to be on the safe side, you can certainly keep them for 7 and then purge after that.
Next question comes from Stephanie. They ask, can we get a copy of the slideshow presented in this training?
So your individuals that are running the facility or the webinar tonight, they will make sure that any information you receive, I believe this is being recorded, and they will make sure that if that is something that they are giving to you, and I'll have Lee talk about that here in just a bit. So I will defer that question to Lee to make sure that it's being addressed appropriately. Thank you.
Let's see. Next question we have in the QA box is from Maria. Maria says, I'm a family daycare sole proprietor, not an LLC yet. Should I give my assistant a W-2 or a 1099?
So that's a great question. Now we have a tool on our website, civitasstrategies.com or civstrat.com, that basically will help you to determine whether or not someone is an employee or a contractor. That's the first thing that you are going to need to do. There are various factors that determine whether or not you should be paying someone as a contractor or as a W-2 employee. So I highly encourage you to run through that. Tim, have you dropped that in the chat? I thought I saw you looking.
Yes,
there it is. Perfect. I knew you were on it. So please take a look at that link that Tim has just dropped in the chat. It will help you to determine whether or not you should be paying that person as a contractor or as a W-2 employee. Perfect question. Thank you. All right. Do we have any more?
Looks like we have 2 more. Another question from Stephanie. They say, should we separate our purchases based on the type of expense, such as groceries, miscellaneous, equipment, and toys?
Yeah, I always recommend you separate those. Now there are categories. And so you definitely want to separate things out so that you know what those are. If you happen to graduate into like a bookkeeping system like QuickBooks or something similar to that, they will actually have some of those categories already there for you. So I recommend you go ahead and just separate everything out so that if you happen to transition into a system like that, it's already done for you and you don't have to do that extra legwork in the long run. Plus, it's very helpful for your accountant in the long run to know what everything is. And it helps you in the long run to be able to know what you're spending your money on. So always separate those things out so that it helps you to understand where your money's going. And if you're spending more, because you can use those to compare and contrast year after year. This year you may have spent $4,000 in food. The next year you might spend $6,000. So you may want to understand what the differential is between the 4 and the 6 from year to year. So I do, yes, absolutely recommend itemizing those out. Thank you for that question as well.
And we have a couple more coming in here. Rebecca asked, does the IRS give reimbursements or deductions for children's food?
So yeah, we covered the children's food. I think the really cool thing about what IRS does is you can use their I think it's the standard where you can claim those extras. So say for instance, if you're on the food program, right? And you can only claim 2 snacks in a meal or 2 meals in a snack. If you use the what the IRS allows you to be able to claim all 5 of those meals, and I hope that I'm addressing this question appropriately, you can claim multiple meals more than what the food program has allowed you by simply using what the IRS has allotted for you to do. And they do have some stipulations to that. So if this is something that you're opting to do, again, we always encourage you to speak with your tax professional to make sure that you're claiming those expenses in the appropriate manner.
We have Karina who asked, please review why the best time to deposit for retirement is January to April 15th. Why is that?
So once you've done all your spending after December 31st, there's only one other thing that you can do to offset the taxes that you would have to pay. So let's say you had that $10,000 tax bill. Instead of paying the $10,000 tax bill, they do give you from January to April 15th to be able to invest those extra funds into a retirement account so that offsets the amount of taxes that you have to pay. So if you have an extra $10,000, instead of paying it towards the taxes, you can invest it in a retirement. And then that would minimize the amount of money that you would end up paying in taxes in the long run. I hope that addressed that question for you.
Next
Please
question we have-
drop more information. Okay, go ahead.
Yeah, we have a couple more. They're coming in. So next question we have is from Cindy, and Cindy asked, I have more expenses than my income when doing my taxes. Is there a certain limit of expenses? Does that put me at risk for an audit?
So as a home-based childcare provider, when you have more expenses than income, it basically doesn't necessarily put you at risk for an audit, but it does kind of put you in a situation where if you're looking to do something in the long run, like purchase a home, it's going to put you in a situation where you're not going to be able to show income, right? So if that's something that you're looking to do in the long run, or you need to show income for whatever reason, then it's best to try to plan ahead to make sure that you're actually showing some income. But the IRS will simply just look at you as a hobby rather than a business if you happen to have too many years of negative profit, if that makes sense.
And we have a couple more questions, but knowing that we're kind of at our time here, are we okay to continue, or is there
Yeah, I want
another?
to check in with Lee because she does want to, there's some post-survey information that she'd like to share. So Lee, we
Hi,
want to check in with you and
Marlene.
see. Yeah, hi.
Hey, yes. What I will do is if people do need to drop off because this is the end of our time, I completely understand. I do have I'm copying them into the chat now, some links to some quick surveys that would be very helpful for us to continue to bring these trainings to you, and some of the trainings that you may have suggestions for as well. We always want to hear from you. So I'm going to put them right, oops. And I have the Spanish version coming up right now in the chat. And so if you have time, it would be lovely for you to fill them out, please. Thank you, Marlene.
Absolutely. All right. So Tim, I'm going to chime in because I saw a question in this is from Nicole, where I mentioned that there were new stipulations for the apps. So I kind of wanted to address that. The numbers, I'm just going to basically give you some numbers. In 2024, if you received $5,000, that would be the threshold. In 2025, that threshold is going to went down to 2,500, and in 2026, the threshold would be 600. So this is the amount of money that you are receiving from those payment apps. We definitely encourage you to also check the information each year to see if things have changed, because sometimes they do, and we don't have a way of sharing that information with you. So we always encourage you to verify the information and see if the thresholds have changed. So that was the information that I wanted to share them in terms of the payment apps and getting those 1099s. Those are the limits that I wanted to share with you. So $5,000 in 2024, 2,500 in 2025, and 600 in 2026. Okay. All right. And Tim, were there any other questions that we had listed?
There are a couple more, but being cognizant of our time here, there's like a handful more. Would you like to try to go through all of them, or should we recommend going to Tom Copeland blog for further
Yeah.
resources?
Yeah, so since we are at our time, I am going to go ahead and let you guys know that in case you weren't able to get your questions answered during tonight's webinar, know that we do have the Tom Copeland blog, and thank you, Tim, for bringing that up. This is full of information that most likely will give you the answers that you're looking for in your questions, but if you don't find those answers, there is also the Ask the Experts panel. Now, don't forget, we do encourage you to subscribe to our monthly newsletter to stay in the know. Again, if you can't find the answers that you're looking for in those resources, and there are well over 1,500, you can simply post your question in the Ask the Experts section of our blog. Okay? All right. And also want to encourage you to visit us at Civitas Strategies for our YouTube channel, where you can find more valuable resources to support you and your business. And we also have that information available for you in Espanol. All right, Lee, I am going to pass everything back to you for final words. And thank you so much for allowing us to be here to present and this session tonight.
Wonderful. Marlene, thank you so much for being here. Tim, for helping us out. This was a really robust presentation with lots of excellent information. So we will be having these trainings with Civitas on different subjects about once every other week on a Tuesday. So please go to the CSEA, I will type that here, CSEA Voice website, and sign up. So register in the topic training. Okay. And so we certainly hope to see you all again soon. Thank you for joining us. Cheryl, is there anything that you would like to add? I think we're all set. Thank you, everyone. Good night.
Take care.
Thank you.